The difference between a valid order block and a fake one could be the difference between a winning trade and a losing one. Many traders enter order blocks that are designed to attract liquidity rather than start a genuine move. In this video, you'll learn exactly how to tell the difference using clear and practical criteria. Now, let's break these two concepts down clearly and examine the precise characteristics that distinguish a valid order block from a fake one. What is a valid order block? A valid order block is a price zone that reveals the genuine footprint of large institutional orders entering the market. Unlike ordinary candles, these zones represent areas where banks, hedge funds, and other major financial institutions have accumulated or distributed significant positions before driving price in a specific direction. Because institutional capital leaves behind recognizable clues, a true order block is never identified by the candle alone. Instead, it is confirmed by the surrounding price action and the market structure that develops around it. So, how can you tell whether an order block is truly institutional or just another trap? Let's look at the key characteristics that define a valid order block. Final liquidity sweep. A valid order block is usually preceded by a liquidity sweep. Before the real move begins, price briefly pushes above a previous high or below a previous low, or taps another significant liquidity pool with its wick on its wick. This move is designed to trigger breakout entries, collect stop-loss orders, and absorb the liquidity that large institutions need to execute their positions efficiently. Once that liquidity has been taken, the market reverses from the genuine order block and begins the intended directional move. Strong break of structure. A valid order block should generate a move that is powerful enough to break the previous market structure, whether it's a break of structure, BOS, in a trending market, or a change of character, CHOCH, during a potential reversal. The breakout must demonstrate clear institutional strength. Most importantly, the break should be confirmed by a full candle body closing beyond the previous swing high or swing low, not just a wick. A wick alone may simply represent another liquidity grab, while a decisive candle close provides much stronger evidence that market structure has genuinely shifted and institutional order flow is now in control. Creation of a fair value gap. A valid order block is typically followed by an explosive move that creates a fair value gap, or FVG, also known as an imbalance. The displacement should be so strong that a price gap forms between the first candle, the order block itself, and the third candle, leaving a portion of the market inefficiently traded. This imbalance reflects aggressive institutional participation, where large orders enter the market with such urgency that price moves too quickly to trade efficiently through every level. The stronger and cleaner the displacement, the more convincing the evidence that institutional order flow is behind the move. Unmitigated status. One of the strongest characteristics of a valid order block is that it remains unmitigated. After price leaves the order block, it should not immediately return to retest that zone. The first revisit is typically considered the highest probability opportunity because the original institutional orders are more likely to remain unfilled. As price reacts to the order block for the very first time, the chances of a strong response are generally much higher. With every additional retest, however, more of those resting orders are absorbed, reducing the zone's strength and increasing the likelihood that it will eventually fail. What is a fake order block? A fake order block, often referred to as a trading trap, is a price zone that appears to meet the visual definition of an order block, but lacks genuine institutional participation. At first glance, it may look convincing. For example, it could be the last bearish candle before a bullish move, or the last bullish candle before a decline. However, its appearance alone does not make it a valid institutional order block. These zones are frequently created by the market's algorithm to mislead retail traders into entering positions too early or in the wrong direction. While traders see an ideal-looking setup, institutions are often using that reaction to gather liquidity before driving price toward the true order block where the real move is intended to begin. So, what separates a fake order block from a genuine one? Let's examine the key characteristics of a fake order block. Internal order block.
A fake order block is often an internal order block, meaning it forms within the middle of an existing price swing, rather than at a significant structural turning point. Because it is not responsible for creating or defending a major swing high or swing low, it carries little institutional significance. These zones may attract retail traders, but they rarely contain enough unfilled institutional orders to produce a meaningful reaction. As a result, price often slices through them with little hesitation, continuing toward a more important external order block, where the real institutional activity is located.
No liquidity sweep. One of the clearest signs of a fake order block is the absence of a liquidity sweep before the move begins. The order block forms and price moves away without first taking out nearby highs, lows, or the stop-loss orders resting around them. Since institutional traders typically seek liquidity before executing large positions, the lack of a sweep suggests that the move was not driven by genuine institutional order flow. Instead, the zone often serves as a visual trap, encouraging traders to treat it as a high-probability order block, when in reality it lacks the liquidity collection that usually precedes a valid institutional setup. Weak or fake break of structure. A fake order block often produces what appears to be a break of structure, but the breakout lacks real conviction. Price may briefly push above a previous high or below a previous low with a long wick, creating the illusion that structure has been broken. However, the candle body fails to close beyond that key level, indicating that buyers or sellers were unable to maintain control. This type of breakout is usually nothing more than a liquidity grab, rather than a genuine structural shift. Without a decisive candle close confirming the break, there is little evidence of institutional commitment, making the order block far more likely to fail. No fair value gap. A fake order block is usually followed by weak, overlapping price action, rather than strong institutional displacement. Instead of accelerating away from the zone, the candles remain compressed, with their bodies and wicks heavily overlapping each other. Because the move lacks momentum, it fails to create a fair value gap or any noticeable market inefficiency. This balanced price action suggests that buyers and sellers are still trading actively at those levels, indicating the absence of the aggressive institutional order flow that typically accompanies a genuine order block. Without a clean imbalance, the probability that the zone represents real institutional activity is significantly lower. Chain order blocks. Another common characteristic of fake order blocks is the formation of chain order blocks. During a strong impulsive move, several order blocks may appear one after another, tempting traders to treat each one as a valid entry zone. However, in most cases, the upper order blocks in a bullish trend or the lower ones in a bearish trend are simply intermediate zones with little institutional significance. Price frequently trades through these areas with ease, triggering premature entries before continuing towards the deepest and most significant order block, where the majority of institutional orders are actually positioned. Understanding this hierarchy helps traders avoid reacting to every order block they see, and instead focus on the zone that carries the strongest institutional footprint. If you found this video helpful, make sure to hit the like button, subscribe to the channel, and turn on notifications so you never miss our next Smart Money and ICT lesson. And if you have any questions, drop them in the comments. I'd love to hear from you. Thanks for watching, and I'll see you in the next video.